So y'all, I'm happy you're here. For those of you who may not know me, I'm Brianna Beers, Bree to my friends, and I own the kind of recently rebranded Bree Beers and Associates, formerly Lipid Beers and Associates. We help small businesses and individuals with tax prep and tax planning. Tax planning is my fave because it's where we get to strategize with our clients to minimize their annual tax burden and keep that extra cash in their pockets to invest back into themselves and into their businesses. I can't wait this year. Side note, usually we do some mid-year tax planning and some year-end tax planning. And because of this year's craziness, we're making some adjustments, which we'll talk about hopefully on Thursday. I'll have some things finalized and some news for you. That said, if you guys, you could be watching this in a variety of places. If it's not in our awesome Facebook community, Money, Taxes, and Finance for Small Business, and you are a business owner, you are missing out. So definitely hop on over there and join that group. It's an amazing community full of supportive business owners, and we're in there giving tips and tricks every day, trainings every week. Those of you that are new to Money, Tax, and Finance, Mondays at this new time, 9 o'clock Mountain Standard, are our weekly training sessions. We'll talk about topics y'all are asking about in the group and DMing me about. And then on Thursdays at 2 p.m. Mountain Standard Time, we go over updates from the week and we open it up to live questions if you have them. So if you can't ever make it live, past videos are in the video section of this Facebook group, or you can watch most of them on our YouTube channel. It's the best place to honestly search for past trainings, because just how nicely organized YouTube makes it. So definitely head over there and check us out there. So let's go ahead and dive into today. So today we are talking about Income 101. So we're going back to the basics. So I am a firm believer that business owners should not be doing the day-to-day bookkeeping and accounting in their business. I don't even do my own. Lindsay does mine because for a few reasons that I think are important. But I do believe no matter whether you are still doing your bookkeeping and your accounting day-to-day, all of it, or you've gotten the chance to hire someone to do it and take a step back, I believe that every business owner should always know where their business stands from a financial point of view. So what I mean by that is, first and foremost, you need to make sure you always know how much money your cash, or how much cash your business has, right? You need to know how much cash is in that bank account, or however many bank accounts your business has, right? So this means you've also calculated and built a reserve, right? An emergency fund. For me, my goal is 9 months. But at a minimum, you should have 3 months worth of expenses set aside, whether that's in a separate bank account, whether that's, I suggest a separate bank account, or whether you just know that number and you know that that's the minimum you let your business bank account drop to. That's not the method I recommend, but at least 3 months of expenses set aside for emergencies. Hello, COVID. But my goal is to save up 9 months worth. I'm not there yet. 3 years in and I'm still not there, but that's a goal, right? And as a business owner, knowing where your business stands also means that you know how to read your primary financial statements. Okay, this means your income statement or your profit and loss, your P&L, all those titles are interchangeable. And it means you know how to read your statement of cash flows. And if applicable, if you have a balance sheet, then you know how to read that as well. So today we're talking about the income statement. We're going to dissect that income statement, that P&L, profit and loss. All right, we're going to talk about what all of those different sections of your income statement mean. So Income 101. So we're going to talk about all of these different terms. All right, so we're going to start with revenue. Okay, so when someone comes and asks you, how much revenue does your business make? Do you know what someone's asking? All right, so if someone asks you, what is your business's annual revenue? They're talking about your gross income, gross receipts, your earnings. Sometimes you might hear it called gross profits. Not necessarily accurate though, but things, all things that can be interchanged. So you guys, when someone says, what is your revenue for the year? Or what is your revenue? What they're asking for is all the money your business has earned before any costs and expenses. All right, so for some of you out there, you have a business and maybe you only receive one 1099 from, let's say you're a real estate agent and you receive a 1099 from the broker you work for. Okay, that 1099 miscellaneous in 2020, it's going to be a 1099 NEC. Talk about that later, but the 1099 that shows how much money you made, okay, that's your gross earnings. That's your earned money, your earned income before you take into account all of your expenses related to your business. Some of you might get multiple 1099s. You're going to add those all together. Some of you don't get 1099s, or maybe you get 1099s, but not for all of your jobs, because maybe you're a contractor and you just do, hundreds of jobs a year. But your revenue is your gross income. Every dollar that your business brings in for running your business, all right, for selling your services or selling your products. So we have our revenue. The next item we're going to talk about is your cost of goods sold, your COGS. So again, if someone asks, what is your business's COGS? What is your cost of goods sold? So this is the cost of producing the goods sold by your company. Okay, it's your materials, it's your overhead, it's your labor. So let's say you're a t-shirt printing company. Then your materials are going to be the t-shirts you order, the ink you order, if you hire someone to actually, design the shirts, what you pay them, that's the labor. And then any overhead costs that might be associated with that. Maybe you rent a warehouse to do this, and that warehouse is specifically for making these shirts. Okay, whatever it is. Whatever all the costs related to producing the product or the good, okay, that's your cost of goods sold. Okay, the key is costs directly related to producing your goods. So sometimes you also see cost of services. And when you're looking from an accounting point of view, like totally fine. But from a tax point of view, I want to just warn you, if you're doing bookkeeping, I just want to warn you not to put cost of service in the cost of goods section of your tax return. I've seen a lot of taxpayers do it and nothing happens, but I have seen audits and then they move it and it's a pain in the tush. All right. So cost of goods is for if you are making an actual physical product. Cost of service. So I'm an accountant. So cost of service, I would have a cost of service, right? So for me, it's my team. It's the tax software that I use. It's all the software I use for, my client database, all those things. But cost of service, it's not something that you see from a tax point of view, which is, how I'm always going to talk to you guys is from taxes. But when you're looking at an income statement or a P&L, you could have cost of service. So take a look at this top, revenue minus cost of goods sold. So it's revenue, all of the money that our business has brought in for providing a good or service, minus our cost of goods sold. So what it costs to make our product gives us our gross profit. Sometimes you also hear the term gross margin. So this is what money is left over after you make your product, right? So you receive all your money for making, you receive all your money, all your income, you have to make the product itself, right? So that what you're left with is gross profit. If you don't have a cost of goods sold, then your revenue is your gross profit, right? If cost of goods is zero because you don't have a cost of goods sold, then revenue equals gross profit. So general rule of thumb, I get a lot of questions about what should my gross profit margin be? How much should I be spending on my cost of goods sold? And I don't even know what kind of accountant does this, a financial accountant, maybe a CFO or even a bookkeeper, but I went and checked with some of the experts. And what I found is that gross profit should be at least 30% of your total revenue, but it does vary a little bit from industry. So what that means is if you make $10, right, when you sell a product, you don't want to spend more than $7 making your product, all right? Because you want to have $3 or 30% left over for all of your other things that we'll get to in a minute, all right? Like I said, that changes depending on your industry. But for the industries that I checked with that I actually have clients in, that's what they told me. So now we got our gross profit, right? Gross profit minus our operating expenses. So what's next? Operating expenses. So this is the rest of your expenses, you guys, that aren't related to cost of goods sold. This is the cost to keep your business running. Okay, so payroll, not related to labor, cost of goods sold, but other payroll, maybe your management fees, anything like that, rent, office supplies, utilities, marketing, insurance, taxes, all of your other expenses, which totally makes me think that gross profit percentage is backwards, but we'll have a whole training on gross profit percentage if you guys need to do that. Because now, like, my brain's going, I'm like, I don't think that's right. But again, not my area of accounting. I had to rely on some other friends. Okay, so operating expenses are all your other expenses. So now we have our gross profit minus our operating expenses. Now we're left with our operating income. So operating income, usually, you guys, in most instances, operating income is going to equal net income because not every business has other income and expenses that we're going to talk about, okay? But if you do, what are other expenses? Do I have them in my business? I don't know. So other expenses are going to be like interest income and expenses, because interest income and interest expenses aren't directly related to running your business. I know you're going to tell me, but I have a business credit card. So isn't that interest that I pay a business expense? You can deduct it on your, in your tax return, but it's treated as other expenses, all right? Because it's considered an investment or an investment activity. Same with an income. You might have interest income coming from a loan that you have out, or dividend or other investment income because your business has invested. Maybe you have your savings account, right? And maybe it's making 2%. And so you're making interest on that account. Okay, that's going to be an other expense. All right. And the last big one is gain or loss on a sale of an asset. So we'll talk about assets in a different training, but assets are big things that aren't considered expenses. So if you have a big piece of machinery, or that's most common, a big piece of equipment or machinery. So those are called capital assets, and we'll talk about those in just a second. Here we go. So operating income minus all these other income and expenses, which your business may or may not have, gives you your net income. Sometimes you refer to this as profit, right? Something that's super important to remember is that your net income is not necessarily and is rarely equal to your cash. Okay, net income does not equal cash, all right? Because there are non-P&L, non-income statement items that affect your cash flow, right? So if you have loans out, all right, principal payments are not on your P&L. Those are what we call a balance sheet or an off P&L item. We just talked for a second about capital asset purchases. So generally speaking, any piece of machinery or equipment or one single item that you pay over $2,500 for is considered a capital asset. So that iMac that you just bought that was $3,000, capital asset, which means technically what that means is you don't expense it on your P&L. There are tax loopholes that may allow you to, but taking a step back, it doesn't go directly onto your P&L, okay? It becomes an asset that you capitalize, and we do what's called depreciation, which means taking a little bit of the expense every year. The last non-P&L item that affects your cash are your owner distributions and contributions, right? So especially if you're a Schedule C business, right? So Schedule C business, you have all the money coming in as income, you have all of your expenses, and what's left is yours to take, right? If you have personal expenses, your personal mortgage, your personal car payments, your groceries that you have to pay, that money is yours to take out as you need to. So those are called owner distributions, and those are not on your profit and loss because they're not a taxable event. All right, so this is why your net income does not equal your cash. And that's where the statement of cash flows comes in, but we're not talking about that today. Too much. We want to just talk about your income statement. So I really want you guys, those of you that are here live, to ask questions about what do you have questions about with income? What are areas that confuse you when you talk about income, expenses, and income statement and profit and loss? So taking a step back, what does it all mean? Okay, why are these numbers important? And as a business owner, what do you focus on? All right, do I focus on revenue? Do I focus on gross profit? Do I focus on operating income, net income? What do I want to set my metrics and my goals on, right? Well, that depends. It depends on what your financial goals are. So I am a believer, still a work in progress, huge work in progress, but a believer in paying yourself as a business owner first. I still get sucked. I mean, I'll be real with you guys. And if Lindsay can hear me, she's probably there laughing because there are times where I don't pay myself for months at a time. But that's not how I want you guys to run your business, okay? I want you guys to run your business so that you're able to pay yourself first. So for me, if I were a Schedule C owner, my net income would be the most important figure for me to figure out, because that net income is where I get to pull out money for myself, right? For me, I would create a personal budget, and then I'd say, okay, this is how much money I need to make personally from my business to make this sustainable, to make this worthwhile, to make my business actually pay myself. So let's say you come up with that, and let's say it's $1,000 a week. So $52,000 a year is what you need to be able to pay yourself personally from your business. So then you work backwards from there, right? So you say, I have to have $52,000 of profit, all right? Well, then you work backwards, okay? And if you're an S Corp, or I think there's a few C Corp peeps in here as well, then how you pay yourself is usually gonna be your W-2 wages, okay? Until your business starts making a ton of money. and you exceed what we call a reasonable salary, W-2 wages are how you're going to work yourself or how you're going to pay yourself. Okay, but same thing. How much do I have to pay myself as a business owner to make this business worth running, right? Because trust me, I've been a business owner for 3 years, and I've spent way too many of those months working in my business for free and working harder than I have ever worked in my life for anyone else. All right. So don't do that, please. So you figure out how much you got to pay yourself. All right. You work backwards. So by working backwards, so now you know how much you want to pay yourself. The next step is to figure out your absolute non-negotiable costs. What are the expenses that I have to have in place in order to make money. All right. So if you're making a product, it's going to be your cost of goods sold, right? That is a non-negotiable cost. In order to sell a product, you have to make it. So there has to be a cost, there has to be an expense that you account for. If you have a team, you have to include that. That is something, whether you have to hire someone or you already have someone hired. So for me, it's my team. They have a salary, they're getting paid. Okay. If you have office space or a warehouse, okay, those things. So you have the number, you have your goal, you have your profit goal number, you have your non-negotiable expenses. Okay. Work backwards. That's the number. Your profit goal plus your expenses equal your revenue goal. All right. So now we have our revenue goal. Ultimately, that's where it all comes down to, right? No matter how you look at it, revenue and growing that revenue number is going to be what ends up growing all the other goals you may have. But it's important to recognize that they do all work together. All right. Because I could say, I want to have $1 million company. I want to make $1 million this year in revenue. Okay, great. I want to make $1 million. But if I'm spending $1.1 million to make that $1 million, what does that mean, right? What does that mean? I believe your profit or however you determine how you pay yourself, that's the most important number to start with. But then it all does eventually go back to revenue. You have to have the revenue to cover your expenses and get you to your profit goals.